Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. In today's episode, we're diving into some significant trends and developments impacting the real estate market across Canada. We'll be discussing how existing home and condo sales have dropped as buyers wait for more rate cuts, along with insights from various real estate boards across the country. Let's get started with our first story. The Bank of Canada's recent rate cut was expected to boost the housing market, but the country's largest real estate board said existing home and condominium sales activity remains mostly on hold as buyers wait for more reductions. The Greater Toronto Area saw 6,213 home sales in its systems in June, a 16.4% drop compared to 7,429 sales reported in June 2023, the Toronto Regional Real Estate Board, or TRREB, said. New listings rose to 17,964, a year-over-year increase of 12.3%. The average selling price of $162,167 was down by 1.6% from a year ago, according to TRREB. The TRREB said the central bank must repeat its June decision to cut its overnight lending rate. In fact, the board said that several reductions probably will be needed before sales volume rebounds. The Bank of Canada's rate cut last month provided some initial relief for homeowners and home buyers, said Jennifer Pierce, president of TRREB, in a statement. However, the June sales results suggest that most home buyers will require multiple rate cuts before they move off the sidelines. Once home sales in Greater Toronto gain momentum, an ample number of homes on the market should ensure pricing does not jump, the board said. The Greater Toronto Area housing market is currently well supplied. Recent home buyers have benefited from substantial choice and therefore negotiating power on price, said Jason Mercer, chief market analyst with the board, in a commentary. Moving forward, as sales pick up alongside lower borrowing costs, elevated inventory levels will help mitigate against a quick run-up in selling prices. Turning our attention to Calgary, the city also saw a significant drop in home sales in June. Sales tumbled 12.8% from the same month in 2023, while new listings decreased by 3.6% and inventory rose by 9.2%, according to new numbers from the Calgary Real Estate Board. Condo sales in Calgary were down 8% for June as properties priced under $300,000 were scarce. The board blamed a shortage of affordable homes across all residential property types. The pullback in sales reflects supply challenges in the lower price ranges, ultimately limiting sales activity, Anne-Marie Lurie, the organization's chief economist, said in a statement. Despite the decline, 40% of the homes sold went for over the asking price, and the unadjusted benchmark home price rose 9% over last June to $608,000, according to the board. The biggest increases were seen in the northeast and east sections of Calgary. The numbers come in the midst of a population surge in Alberta's biggest city. Calgary's 5.9% population growth between 2022 and 2023 was the highest of any of Canada's 6 metropolitan areas, with a population of over 1 million, according to recent Statistics Canada data. However, its 8.1% unemployment rate remains one of Canada's highest, although it is partly explained by the 73% labor participation rate, Canada's highest. In Canada's most expensive city for housing, Greater Vancouver realtors said the area has become a buyer's market, with inventory continuing to accumulate to levels not seen since the spring of 2019. The organization said this week, June sales in the region were 2,418, a 19.1% decrease from the 2,188 sales recorded a year earlier. The sales numbers were 23.6% below the 10-year seasonal average. The June data continued a trend we've been watching where buyers appear hesitant to transact in volumes we consider typical for this time of year, while sellers remain keen to bring their properties to market. Andrew Liss, Director of Economics and Data Analytics for the Greater Vancouver Realtors, said in a commentary. This dynamic is bringing inventory levels up to a healthy range not seen since before the pandemic. This trend is providing buyers more selection to choose from and driving all market segments toward balanced conditions. Like Toronto realtors, Vancouver agents are hopeful the Bank of Canada cuts its interest rate again. The central bank is set to release its next announcement on July 24th. This is yet another factor tilting the market in favor of buyers, even if the boost to affordability is modest, said Liss, about a potential rate cut. But June's lower-than-normal transaction volumes suggest many buyers remain hesitant, which has allowed inventory to accumulate and has kept a lid on upward price pressure across market segments. The group's composite benchmark price for all residential properties in Metro Vancouver is currently $1,207,100, a 0.5% increase from a year ago and a 0.4% decrease compared to May 2024. Montreal, Canada's second-largest city, proved to be a bright spot in June, when the greater metropolitan area saw a 6.4% increase in residential sales in the greater metropolitan area over the same month last year, according to the Quebec Professional Association of Real Estate Brokers. Meanwhile, the Royal Bank of Canada issued a report Thursday that suggested housing has a long way to reach affordability, but is headed in the right direction, with rate cuts driving that movement. We think ownership costs have room to fall further in the period ahead. In June, the Bank of Canada initiated what we expect will amount to a full 2 percentage point cut in its policy rate to 3% by the end of 2025, which will bring down long-term rates as well, but to a lesser extent, the bank said in a commentary. First National Financial saw its single-family mortgage originations fall in the second quarter, with increased market competition partly to blame. But the Q2 results were in line with past forecasts, given surprisingly strong activity in Q2 2023, according to First National President Jason Ellis. The borrower psychology was different. There was a temporary reduction in rates due to what was going on in the United States and with Credit Suisse, he said on First National's earnings call. But also, admittedly, in Q2 of last year, a significant competitor was absent from the market, and so that, I think, made our Q2 over Q2 a difficult comparison. Overall, however, First National saw its mortgages under administration rise 8% compared to last year, driven in large part by its commercial lending portfolio, which was up 35%. While the Bank of Canada's initial quarter-point rate cut in June did little to stimulate Canada's housing market late in the second quarter, Ellis says activity should pick up in the second half of the year with subsequent interest rate cuts. When combined with the second cut on July 24th, we may see some increased activity in the second half of the year, he said. First National had indicated in its Q1 earnings call that single-family mortgage originations would be lower on an annual basis due to the factors mentioned above that resulted in extraordinary volumes during the same period last year. While part of that was driven by falling fixed mortgage rates, another factor was Scotiabank's deliberate choice to intentionally slow the growth of its mortgage book at the time. However, early in the third quarter of last year, Scotia reintroduced more competitive pricing, which shifted market dynamics, intensified competition among lenders, and put downward pressure on origination volumes industry-wide, including at First National. The bank's return meant market share positions reverted to more traditional levels for other participating lenders, including First National, Ellis explained on the call. All else being equal, however, First National has retained its relative position in the channel. And while originations were down from last year, they were still up 74% from the first quarter of this year. Despite the challenges with single-family originations, First National experienced strong growth in its commercial lending business, with originations, including renewals, rising 35% to $5 billion for the quarter. This growth was fueled by increasing demand for insured multifamily financing, according to Ellis. Looking forward, Ellis said new single-family commitments in July were higher than the same month a year ago. It's too early to call this a trend, but we are cautiously optimistic that this is the case, he said. Nonetheless, our official position is to expect single-family funding to be lower in the third quarter than last year's $8.3 billion based on the existing pipeline. First National President and Chief Executive Officer Jason Ellis also commented on the pressures from market competition during the company's earnings call. While the spreads we're observing at origination on residential mortgages right now are under some pressure, probably the most significant source of that pressure has been in some of the additional incentives being paid to mortgage brokers as lenders. I also know that one of the bank lenders in the channel may have been at the margin more aggressive than typical as it fought its way back to its traditional position within the channel after having stepped back last year, he said in what was a clear reference to Scotiabank. I think that some of that will be moderating. Ellis also discussed First National's alternative lending portfolio, noting, "Our Excalibur volumes were lower by a similar magnitude as our prime products, a not surprising outcome as the relatively higher rates have made it even more difficult for borrowers to qualify in the non-prime space." On the topic of mortgage arrears, Ellis said, "First National borrowers continue to hold up well against the stress of today's interest rates. 90-day arrears represent just 8 basis points of our prime book, compared to 7 basis points at the end of March and 5 basis points a year ago. The historical tendency toward 5-year mortgage terms has certainly served our prime borrowers well." Ellis noted that due to the shorter terms for Alt-A products, First National's Excalibur arrears rate is higher compared to its prime book. However, with a stable housing market and our concentration in liquid urban centers, there were virtually no realized loan losses in the quarter. Even so, as a prudent lender, First National continued to accumulate provisions for credit losses, which we have not released into income at this stage. Ellis also referenced First National's new underwriting partnership with BMO, which re-entered the broker channel in January. "We're pleased with the progress in establishing a growing underwriting and fulfillment platform for them in the broker channel," he said. On the commercial lending outlook, Ellis was optimistic. "We expect origination volumes to surpass last year's Q3 production of $3.3 billion. In June, CMHC made refinements to some of those programs, which caused an increase in application volumes along with the recent increase in funding available from the Canada Mortgage Bond Program, removal of GST for new construction. There is support for ongoing activity even in the face of today's interest rates. While these headwinds have fostered competition for the multi-unit space and have had a related impact on available spreads, First National remains a profitable market leader in this market." Carla Giles, the Chief Executive Officer of the Canadian Mortgage Brokers Association, British Columbia, has had an eventful journey to her current role. She came from outside the mortgage industry, bringing extensive executive experience from prior leadership positions. This background has proven invaluable as she advocates for mortgage professionals and helps brokers navigate a changing landscape. Giles's global perspective stems from her childhood travels due to her father's work with the United Nations Food and Agriculture Organization. Her upbringing and education took place mainly in Brazil and Italy, where she attended French school, followed by university studies in England and Canada for her master's degree. This international exposure has given her a unique viewpoint on the industry. Before joining CMBA-BC in 2022, Giles spent nearly a decade at the Canada Green Building Council, developing expertise in the real estate market. "We worked quite a bit with construction, housing developments, understanding the needs to advance our thinking in Canada about the building stock," she explained. "So that provided me a really good understanding about the different players within this industry, which is shared and overlaps with the mortgage industry." Her role at the Canada Green Building Council provided a strong foundation not only from the real estate industry side, but also from governance, operational, and organizational development perspectives. This experience allowed her to understand the needs, priorities, and challenges of the industry, and to set effective directions and priorities for CMBA-BC. Giles stepped into her current role at a time of significant change within the mortgage industry. One of the biggest challenges has been the increasingly complex regulatory environment at both provincial and federal levels. You have the provincial, federal, and OSFI with rules and regulations regarding stress testing, which directly impacts the qualification for clients that the broker needs to know about and needs to advise clients on, she said. Giles highlighted the legislative efforts to address the housing crisis, which often impact the mortgage process, typically mortgage approvals. There is no easy solution to streamline the mass of mortgage regulation in Canada. Unlike Australia, which has a national framework, Canada still operates with separate arrangements at state and federal levels. Giles believes that collaboration and relationship building with provincial and federal partners are essential for any significant change. Giles, who serves on the board of the International Mortgage Brokers Federation and appeared on a panel at its inaugural World Summit in Las Vegas last year, said that the increasing level of scrutiny in Canada is a concern for many members. They differentiate between the need to look for bad actors and to check and make sure that certain transactions do not go through that could be mortgage fraud, but at the same time, they are building so many layers of compliance that are impacting the work of a broker, she said. The International Mortgage Brokers Federation is set to launch a white paper listing common concerns on global regulatory mortgage industry issues and sharing lessons and possible solutions that have worked elsewhere. This initiative aims to help streamline regulatory processes and improve the industry landscape. Giles also emphasized the importance of keeping brokers informed about regulatory changes and technological advancements. There's a portion of the population that's not covered by either being part of larger networks or being part of the associations, and that's what we're worried about, she said. We need to be fostering innovation, looking at ways in which we can identify some big gaps, and we also need to look at financial literacy. One of the striking aspects of the mortgage industry for Giles has been the passion and enthusiasm of brokers and other professionals. She is eager to ensure that conversations around well-being and maintaining a solid work-life balance come to the forefront. This is not an easy industry, she said. We're increasingly recognizing the intrinsic link between mental health and professional success. There's too much pressure. We need more conversation about the importance of being grounded, connection, and well-being. That can help create a more resilient, responsive industry. Now, here's a fascinating perspective for those of you contemplating significant life choices. According to a recent report by real estate website and brokerage Zoocasa, it's actually cheaper to get married than to buy a house in several Ontario cities. That's right. If you're debating between tying the knot or putting a down payment on a home, the numbers might surprise you. The report indicates that the average wedding in Ontario costs between $22,000 and $30,000, based on data from Spring Financial and wedding website, The Knot. While that may sound like a hefty price tag, it's nothing compared to what you'll need for a down payment on a home in major southern Ontario regions, such as the Greater Toronto Area, Hamilton, Burlington, and the Niagara region. For example, in the Greater Toronto Area, the average house price is a staggering $162,167. A typical down payment would be around $232,433. That's over $200,000 more than what a couple might expect to spend on their wedding. In Hamilton, Burlington, the average home price comes in at $922,273, with a down payment of $67,227. Even in the Niagara region, which is relatively more affordable, the average down payment is $46,508, while the average home price is $715,070. Just outside the Greater Toronto Area, Kitchener-Waterloo is another region where a wedding is more affordable than a typical down payment. The average house price in this area is $794,201, meaning prospective homebuyers can expect to spend $54,420 to secure a home. That's $24,420 more than the cost of an average wedding. But it's not all bad news. The report notes that there are many cities across Canada where investing in a home is more budget-friendly. For instance, in Windsor, Essex, a down payment might come to about $30,131, which is roughly the cost of a wedding. Similarly, in Sudbury, the average down payment is $27,504, and in Thunder Bay, it's $18,184. Even Montreal offers a closer comparison, with the average down payment sitting at $38,782, not much more expensive than a $30,000 wedding. However, it's interesting to note that in most of Canada, housing remains more attainable than a big nuptial celebration. The report found that in 56% of Canada's major real estate markets, a down payment is more affordable than hosting a wedding at the average cost. This includes cities such as Regina, St. John in Newfoundland, and Trois-Rivières. Despite this, the report does emphasize that there's more bang for your buck in real estate. While opting for a wedding might be more affordable in the short term, investing additional funds into a larger down payment can lead to greater long-term financial security by reducing interest payments. It's a classic case of short-term celebration versus long-term stability. So, whether you're planning to walk down the aisle or sign on the dotted line for a new home, it's crucial to weigh your options carefully. Both choices come with their own set of financial implications and rewards. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. Thank you for joining me, Steve Hamoan, as we navigated through the latest trends and developments in the real estate market. Be sure to tune in next time for more insights and updates. Until then, take care and make informed decisions.